Hello and welcome to Bondcast, a podcast series where we discuss the latest themes and events shaping rates markets. I'm Imogen Bachra, European rate strategist, and I'm joined today by our global market specialists, Giles Gale and Theo Chapsalis. Before getting into today's discussion, I'd just like to remind you to hit the like button and subscribe to our channel so you can get the latest episodes as soon as they're available. Okay, Theo, let's start with the UK. I was very excited last week to say that we were going to have a week where we didn't talk about the Bank of England, but they're back in focus this week with Governor Bailey on the wires again. What's he been saying and what's your take on all of that?
So Governor Bailey, who has been termed to be the unreliable boyfriend number 2, was again back in the wires, as you say. The topic is really the path of hikes and whether a December hike is likely. Now, Governor Bailey made the point that in his decision in November, it was a close call between voting for a hike and not. So right now, this week, we did get some data points. So we did get, very strong inflation numbers. We did get very strong employment numbers. Specifically, the latter, the employment numbers, are very relevant for the BOE. So the reason why Governor Bailey and the BOE, they were hesitant to pull the trigger and deliver hikes at the November meeting is really because of the state of the labor market and the high option value of waiting. So there will be also one additional data point before the December MPC meeting. But so far, it seems that the post-furlough process and progress in the labor market is satisfactory for the BOE.
Yeah, so you mentioned, this week we've had strong labour market data. We obviously had a strong beat to expectations on the inflation front as well. Our official house call is for no hike in December. Is this strong data and what Governor Bailey is saying kind of tipping the balance for you in favour of perhaps getting a hike in December?
Definitely. And as things stand, the market almost fully prices in the hike in December. There may be still, from a risk-reward point of view, a good case to try to fade it. But from a probabilistic point of view, and if one asks me, do you think that is now a hike more likely than, say, at the beginning of this week? A December hike, I would say definitely yes. Now, this makes us also think about it, and we think that actually a December hike looks a lot more likely because, as you've said, there are specific data points. If the data points are right, and inflation is also pushing the BOE to be on the hawkish side, then earlier hikes are likely to come in the market.
What about on the gilt front then? Does this kind of change how you're thinking about gilts, I guess, specifically on the cross market, because that's been a key view of yours for the last couple of weeks?
Yeah, I think to be fair, and it's actually a bit more than a couple of weeks. It's about a month is one of my favorite views, the cross-market view. This is something that I still think has got merit. Now, clearly, we understand that the BOE there will have to be, and there will likely be more hawkish, but then we talk about a curve which inherently is going to be flat. So rate rises happening sooner. We talk about a terminal rate, which probably will not have to be much higher than the previous high. So we talk about a terminal rate, which will be around 1%, 10-year yields at around 1%. Is that fair? For me, it is fair. So when I think about global markets and the outlook, we do have a significant degree of hawkishness in the price at the front end of the UK market. Which is, which means that pricing additional hawkishness and additional weakness, even at low maturities, becomes more difficult. So to me, as things stand, I still like gilts as an asset class. I think that relative to other markets, this is the asset class one should hold. But then again, we may see higher yields, everywhere, with UK yields having a smaller propensity to rise. So you may see a so-called outperformance in the sense of be the asset class that loses less than other fixed income assets.
Yeah, that makes sense. Thank you, Theo. All right, over to Europe then, Giles. I've got a couple of questions this week, which are probably a bit more micro than we usually focus on in Bondcast, but I think it's really been the theme that's kind of been dominating our discussions internally and with clients this week. So probably right to touch on it. And we did touch on it a bit last week, but obviously the move in swap spreads over the last, it's been going on for a while, but particularly over the last 5 days as they continue to reach new highs has been bothering markets. What's your take on what's driving all of this?
Yeah, it's funny, isn't it, that we've had all this strong data out of the US and the UK, and we end up talking about swap spreads because nothing else really is actually moving in Europe. Listen, I think there are two strands to this. One is the collateral side. This is this idea that cash is king, for want of a better word, in Europe again. The idea here, maybe wasn't obvious, but we're coming up to the year end. There's always a strong bid for cash. Basically a safe place, a low duration place to just squirrel away your money, stand, keep things tight, and hopefully just look for good opportunities for next year, I suppose. So this is something that we often see at the end of the year. I think that a combination of high macro volatility, uncertainty, and a difficult year for many kinds of investors just means that the overall demand to really just park money in low duration assets is stronger than usual. And so we're seeing that manifest itself in lots of ways. T-bills, for example, for European governments. A whole array of cash assets in the front end, including government bonds. So that's one part of it, but that really doesn't explain the whole of it at all. There's clearly excess paying in swaps as well. And there are a few theories around, there are some stories around potential positioning difficulty associated with positions that people have been running over the year, which are still unresolved. That may or may not be true, but it certainly feels like it. You just look at the volatility in these spreads. We've been pushed a long way away from fair value. This is something that we model, and historically our models are pretty successful. We're a long way away from those. Another theory maybe is that there's just it's part of a setup for next year, or perhaps even there's a TLTRO operation in the middle of December that banks might be thinking about what they're going to do with money that they're expecting to get from that. If they're thinking about buying assets in the short term, maybe they're rate locking in a sense, that early by paying in swaps. Who knows? I don't have strong feedback to suggest it, but it's a theory that fits.
Just for anyone listening who's not as au fait with the acronyms as we are, TLTRO is the ECB's targeted long-term refinancing operations, which is their sort of cheap lending as part of their pandemic measures. Speaking of the ECB, they announced some changes to their cash collateral this week. Was that designed to kind of ease some of this pressure at the front end, and has that helped?
Well, yes. I think it clearly was designed to alleviate in some small measure stresses, or the anticipation of maybe they're trying to preempt anticipated stresses in cash markets. But it's quite a limited tool. It's really quite restrictive in what it does. It's quite short term. There are position limits and so on. So and it hasn't really been since in the couple of days since it was announced, it hasn't really made any difference. And in fact, asset swaps have widened since again. So it may provide something of a floor, a soft floor, if you like. Particularly at moments like around the year end, where you often markets often become that characterized by gapping. So one transaction happens at one level, and then there's a big gap, and there's another transaction at a significantly different level. So it may serve to alleviate that a little bit.
So we've only got small alleviation of pressures from the ECB, and you talked about one of the drivers of the move being just partly due to the fact that, the time of year and the fact that we're close to year end. Does that mean that you see these pressures kind of continuing into year end and perhaps only easing up once we get into 2022? Or do you think that swap spreads could reverse some of the move sooner than that?
I think probably the answer is I certainly wouldn't expect to see asset swap levels persisting at these sorts of wide levels far into next year. I'd actually be relatively surprised to see them persisting well into December. Now, one of the problems is that the kinds of to correct this, I suppose you need investors to take a view on value and carry, and these are difficult things in this period of low liquidity, high macro uncertainty, and in particular, the year-end period for funding assets is a really complex and uncertain period, and just taking that risk in any meaningful way probably is something that investors aren't going to want to do. So I would say that the chances are that we will see this persist to some extent into Christmas and the year end.
All right. Thanks, Giles, and thank you, Theo, too. And just a reminder before we close out this episode to our listeners that if they did like today's episode, to please hit the like button and don't forget to subscribe so you can get our latest episodes as soon as they're available. And as ever, if you have any questions for our Bondcasters, please email us either individually if you have our contact details or at bondcast@natwest.com. See you next week.